So how do the wealthiest people on Earth legally pay almost nothing in taxes? It's a huge question, and thanks to a bombshell investigation by ProPublica, we're going to break down the exact strategy they use. And as you're about to see, the answer is kind of hiding in plain sight.
Let's start with just one number, 3.4%. ProPublica got their hands on secret IRS files, and they found that was the true tax rate paid by the 25 wealthiest Americans between 2014 and 2018. Now think about that. Their combined wealth skyrocketed by over $400 billion, but what they paid in federal income tax was just a tiny fraction of that growth.
So how is that even possible? I mean, the average American household pays somewhere around 14% in federal taxes. But here's the real kicker. This isn't a story about some illegal cloak-and-dagger tax evasion. It's a story about understanding the rulebook better than anyone else.
Take Jeff Bezos, for example. In 2007, and then again in 2011, when he was already a multi-billionaire, his federal income tax bill was zero, nothing. In fact, in 2011, his reported income was so low that he actually claimed and received a $4,000 tax credit for his children. And it's not just him. You see the same pattern everywhere. Elon Musk, who was the second richest person in the world at the time, also managed to pay $0 in federal income taxes in 2018. These aren't just flukes. They're the result of a very specific and very repeatable strategy.
But maybe the most jaw-dropping case is Warren Buffett. This is the guy who's famous for saying the rich should pay higher taxes. Yet the data shows that while his wealth grew by over $24 billion, his true tax rate was just 0.1%. To put that in perspective, for every $100 he added to his massive fortune, he paid less than 10 cents in tax.
All right, Section 1, the billionaire tax puzzle. To solve this, you have to forget about illegal schemes. The answer is actually built right into the U.S. tax code. It's all hidden in one single, crucial distinction.
And that distinction is between what we call unrealized and realized gains. So, an unrealized gain is basically the increase in value of something you own but haven't sold yet, like your stock portfolio or your house. A realized gain is the actual cash profit you make when you finally sell it. This difference, well, it's everything. And here it is. This is the key. The U.S. tax system is designed to tax income, not wealth. And all those unrealized gains, the billions of dollars a founder's stock shoots up in value, that's legally considered wealth, not income. So you don't owe any tax on it until you actually sell.
So that brings us to Section 2, the golden rule. If you're ultra-wealthy, the #1 rule is simple. Avoid generating income at all costs, even while your wealth is absolutely exploding. And that one principle unlocks the most powerful tax avoidance strategy there is.
It's a 3-step playbook that was first laid out back in the 90s by a law professor named Edward McCaffrey. He gave it a pretty unforgettable name: buy, borrow, die. This is the core strategy that lets billionaires live these incredible lifestyles while reporting little to no taxable income. Okay, so step 1 is buy. You use your money to buy assets that you expect to grow in value over time. We're talking about things like stocks in your company, giant real estate holdings, fine art, you name it. Anything that grows your wealth on paper without giving you an immediate, taxable paycheck. Now, step 2, borrow. This is where the magic happens. When you need cash to live on, you absolutely do not sell your assets because that would create a taxable gain. No, instead, you just go to a bank and use those appreciating assets as collateral to take out a huge, low-interest loan. And because a loan is an income, the cash you get is completely tax-free. You get to fund your lifestyle, all while your original wealth just keeps on growing. And the final step, well, it sounds a bit morbid, but it's die. And this is the ultimate tax avoidance tool. There's a feature in the tax code called the step-up in basis. When your heirs inherit all your stocks and assets, the IRS basically hits a reset button. The original purchase price gets stepped up to whatever the assets are worth on the day you die. So all those decades of growth, all those unrealized gains are just legally wiped away forever. Your kids could sell everything the very next day and pay absolutely zero capital gains tax. So there you have it. Buy, borrow, die. It's like a perpetual wealth machine. But the strategy doesn't even stop there. The ultra-wealthy also have a whole toolkit of advanced methods to push their tax bills down even further, sometimes all the way to zero.
One of the most powerful tools in that kit, especially if you're a real estate investor, is something called cost segregation. It's a tax strategy that lets you massively accelerate depreciation. So in simple terms, you get to write off the wear and tear on your building way faster, which creates these huge paper losses right at the beginning.
Just look at this case study. It's perfect. So, an apartment building brings in $120,000 in real, cold, hard cash. But after doing a cost segregation study, the owner can claim over $450,000 in depreciation deductions. And the result? The taxable income flips from a positive number to a massive paper loss. The tax bill is zero, and that leftover loss can be used to wipe out other income for years to come.
Another really common strategy is called tax loss harvesting. This is where you strategically sell investments that have gone down in value. Why would you do that? Well, you create a loss on paper that you can then use to cancel out the taxable gains from your investments that did really well. Then you can just take that money and immediately reinvest it in something similar, so you never even really leave the market.
And that brings us to Section 4, Advanced Tax-Saving Tools. So when you combine that core buy, borrow, die strategy with these advanced tools like cost segregation and tax loss harvesting, you get a system where fortunes that are worth billions and billions of dollars can legally produce a tax bill of zero.
Now, believe it or not, this debate is nothing new. This warning came from the outgoing Treasury Secretary way back in 1969. He had just revealed that 155 high-income American households had paid zero taxes. There was huge public outrage then, but as we can see today, the core issues are still very much with us.
So what's the solution? Well, there are a few big ideas being debated. One is a wealth tax, which would tax assets directly every single year. Another idea is to start taxing those massive unrealized gains annually instead of waiting for a sale. And some proposals want to close that borrow loophole by treating those big loans as a taxable event.
And the potential impact of these changes is pretty significant. According to Yale's Budget Lab, just targeting the borrow step of the strategy could raise over $100 billion in federal revenue over a decade. And that's just one piece of the puzzle.
Which brings us to our final section, Reforming the System? A fierce debate. Because of course, none of these potential fixes are simple. Each one comes with its own set of incredibly complex challenges, and, as you can imagine, a fierce debate about the potential economic fallout.
And that leaves us with the fundamental question that's really at the heart of this entire topic. In an economy where the growth of wealth and the earning of income have become two completely different things, how do we even define what's fair? And what kind of system can we build that can effectively and equitably tax both? That right there is the multi-trillion-dollar question facing policymakers, and really, all of us.